Income returns from a fixed income point of view have stayed low. This is part of the central bank's toolkit in terms of stimulating the economy and protecting it against some of the shock that was caused by the COVID environment. Unfortunately from that part of portfolios, the income has still remained, virtually non-existent when you consider what the cash rate is. The good news is, from an equities point of view, is many of the restrictions that were put on, for instance, the Australian banks who were largely restricted from paying dividends this time last year, have been released. And so, on a 12-month basis, income has actually picked up a little bit, even though it's certainly not back to where it was in 2019. With capital and income, you need to realise that capital and income are really sort of two sides of the same coin. You can't really separate them. And when we think from a purely theoretical point of view, what we're doing when we're valuing capital is effectively discounting cash flows from the future to today. And so the way we discount that is by using the current interest rate. Now, as interest rates go down, what that necessarily means is that those cash flows that are being measured at today's date are effectively discounted less. And so by that interest rate going down, that pushes up capital values. Over time, you expect that to balance itself out, and you'd expect to see that as we move forward. Markets become a little bit more normal, interest rates rise up a little bit, and at that point in time, there will be a bit of a downdraft on capital. But it's important to remember that the two are intrinsically linked. It is ultimately the capital that produces the income. It doesn't suit us at all to have the majority of returns coming from capital. As conscientious investors, not only do we like to consider, both groups of beneficiaries in our investment approach, but just as purist investors, in a perfect world, you get a blend of returns that generate your total return. So you get a bit coming from income and a bit coming from capital, and together they perform nicely. So when we refreshed our asset allocations towards the end of last year, one of the things we did do was move away from government bonds, which are yielding almost nothing at the moment, and in certain countries are actually producing a negative income, and moved more towards corporate bonds, so bonds issued by banks or large companies. So we continue to scan the environment for opportunities of where we can improve that balance. But one thing that does sort of inhibit that is most income in all asset classes is effectively underpinned by the interest rate dictated by central banks or maintained by central banks. So it's not an easy problem to solve, but we're working hard to look for ways to solve it. Income returns for the rest of 2021, we're not expecting any dramatic changes in the very short term. But what we are expecting is a gradual return to the levels we saw in 2019. So already it's unlikely that, or certainly central banks who control these things, aren't looking to put up interest rates for another couple of years at least. The market is pricing in a higher chance of that coming sooner. And so there's likely to be a sort of a tailwind or an upward push on income over the coming 6 months, year. But don't expect any sort of sudden sea changes. There is a stability in place, and actually it would be worrying from a market point of view and would create systemically risky events if it happened too suddenly. Think of it, doing anything suddenly, you risk that inherent shock from that sudden movement. So what we're probably expecting is a slow and gradual return to what was normal a couple of years ago.